just real quick look at the financial statements. You should already be pretty familiar with this. Public colleges like Texas A&M Kingsville, they're like doing an enterprise fund, right? So you should know what those look like. And private colleges present in the restricted revenues column. So we did that just in chapter 10. So there's really not anything different. The point is you need to remember public colleges are really government entities, and so they're enterprise fund format. Private colleges are restricted revenues. Oops, sorry. And again, the position statement, the big difference is down here in what we would call the residual accounts, right? So at a corporation, you would call it the stockholders' equity section. Assets minus liability equal what? Well, what they equal in a public university like Texas A&M Kingsville is net position, just like anywhere else in the government. So you got your net position, which can be in capital assets, restricted and unrestricted. At a private university like Rice, Harvard, Yale, assets minus liabilities equals net assets, and they divide those up into permanently restricted, temporarily restricted, and unrestricted. To do a statement of cash flows, right? So for a public university like Kingsville, remember we're working like an enterprise fund. An enterprise fund has a statement of cash flows, and it has those 4 sections, and we have to use the direct method, right? So that still applies. That's not any different. We're a public university, so that's how that works. Harvard, Yale, Vanderbilt, Stanford, Rice, Trinity's, SMU. Those are private universities, and they're going to use the FASB rules, which has 3 sections and can choose between direct or indirect. One last topic I want to touch on. I might expect you to know on a high level, like, oh, there's these different kinds of split interests. What does the split interest mean? I'm not going to really make you get into big details about how to recognize these, but I would maybe more expect you to know the definitions between them. All right? So, people give lots of money to universities. They leave it in their wills. But people, sometimes these folks who leave money in their wills, well, they don't want their spouse who's maybe still alive to not be able to live in their house or something. So, or their children to get some of it, or set up a life estate, or create a trust that gives money, part of the money to this person, part of the money to that person, or 2 charities. I want to leave some to Texas A&M Kingsville. I want to leave some to the Humane Society, and you guys are gonna have to split the proceeds, and I'm gonna set up this trust. Just there's all different ways of setting things up with life estates and not, and in trust. So I kind of expect you on a high level to know the distinctions between these different kind of trusts, but I'm not gonna expect you to memorize how to account for everything that goes on in all of them. So just kind of what we're gonna talk about here. All right. So split interests means somebody has made a donation to the university, and also somebody else has an interest in whatever it is that's being donated. So you can imagine they've donated their estate, they've donated their house, they've donated something that has a cash flow, a permanent fund that has a cash flow, and half goes to the university and half goes to the Humane Society. So they've donated something, and there's somebody else that also gets some of the benefits of it. So there's 2 categories. First is a lead trust, right? And the second is a remainder trust. So in a lead trust, the charity receives the income during the life of the trust, and when the donor dies, the trust terminates and the resources go on to the heirs, right? So it's kind of opposite of what you usually think about. You think, oh, the university will get it when they die, but sometimes they're getting this thing while the benefactor's still alive, and then when the benefactor dies, they want their kids to have it. So second type is a remainder. The university receives the resources upon termination of the trust. So lead, we get it first, then something happens, somebody dies, and it goes to the actual children. Or we don't get anything until the person dies. Well, we might get something. Okay. So there's these different agreements, and we'll talk about each of them. Charitable lead trust, perpetual trust held by a third party, charitable remainder trust, charitable gift annuity, and a pooled life income fund. So we'll talk a little bit about each of those, and then we'll be done. So a charitable lead trust. So slightly different for private and public. When a trust is created, college records it at fair value. Then they recognize the present value as contribution. When a trust is created for a public school, the college records it at fair value and records the present value as deferred inflow. Perpetual trust held by a third party. So think about somebody set up some money somewhere, and the money that's generated from the trust. So I put $1 million in the bank, and I'm going to say you can have the interest. So if the college is private, they're an asset at fair value. If it's public, it's an asset at fair value and deferred inflow. Income received each year at the private is recorded as revenue. Income recorded each year at the public is recorded as revenue. Gift annuities. A charitable remainder trust with the college serving as the trustee. This is what I kind of tend to think of as a more typical thing. Under the trust, the spouse receives an annual distribution. And once that spouse dies, then it all goes over to the university. So if you have one of those remainder trusts or a charitable annuity, under a private, the college should recognize the assets at fair value, and so should the public. A liability to the spouse is recorded for both of them. We're going to have to pay a certain amount to that spouse who stays alive. And then the difference between that asset and the liability is recognized as contribution revenue at a private and as deferred inflow at a public. And finally, there's this pooled income fund. The assets are recorded and entered in the pool at fair value. Recognized immediately as the present value, and the difference is deferred revenue. GASB does not actually address this, but the board indicates that they may think about that in the future. So that's it for universities. Go out there and do that homework. Look at the Rice University and Texas A&M Kingsville statements and see if they look alike or different.